Good morning, everyone. This is a hearing of the Minnesota Senate Taxes Committee. It is Wednesday, April 8th at 8:36 a.m. A quorum is present. First item is approval of the minutes. Are there corrections or additions to the minutes? Seeing none, the minutes are approved as presented. First presentation we have today is a review of the Department of Revenue's tax incidence study. Members have the both the larger actual book that describes the tax incidence study and its purpose and how we use it. And you also have the slides that are going to be shown on the screens in front of us. The presentation will be by Eric Willett, who is the Tax Research Director for the Minnesota Department of Revenue. Welcome to the committee. Mr. Willett, if you would introduce yourself.
Madam Chair, members of the committee, my name is Eric Willett. I'm the Director of Tax Research at the Minnesota Department of Revenue. It is my pleasure to present to you today the latest iteration of the department's tax incidence study. We've been doing this study by legislative mandate since the 1990s, and it is a very large effort by a lot of staff that goes into this report, so we hope you find it useful and interesting. I've got a lot of materials in my slides. In the interest of time, I'll go through them at some pace, but if you want me to slow down or zoom in on anything, please interrupt me if that sounds good.
Mr. Willett, anytime someone has a question, I will welcome your being interrupted, okay? Thank you. Continue.
Very good, Madam Chair. I look forward to the interruptions. Okay, so the outline of what I'm going to cover today is a very broad overview of the study and why we do it. This study focuses on tax year 2023 and a projection year of 2028. So I'll go through the summary results of what we know about and estimate about taxes in 2023. We'll do a comparison to previous studies. For those of you who've seen this presentation before, I'll try to put the new results into context. I'll talk a little bit about the impacts of recent law changes and how that affects tax incidence. And then I'll end with a quick comparison of Minnesota to other states in terms of tax incidence. So the purpose of the study is to attempt to answer the question, who ultimately pays Minnesota's state and local taxes? The study includes all Minnesota state and local taxes that are part of the state tax code, chapters 270 to 297A, 298 maybe. It includes taxes paid that are initially paid directly by individuals and those that are paid initially by businesses. But it doesn't include all the taxes Minnesotans pay. It excludes Minnesota's tax burden from taxes levied by other states and countries. When you travel and spend money, you're paying taxes to other places. We do not factor that into the report. It also excludes federal taxes that Minnesotans pay. The next two slides are just a list of the largest of the taxes to give you a sense of the order of scope. For taxes that are initially paid by business, the largest ones are property taxes, sales tax and motor vehicle sales tax, and the corporate franchise tax. For taxes that are initially paid by individuals, the largest ones are the individual income tax, which is our largest tax at $15.3 billion in 2023, homeowner and cabin property taxes, sales and motor vehicle sales taxes. And you can see the rest of the list on the slide. And all these are outlined on table 2-1 in the full report. So probably the most complex part of this report is figuring out what the incidence of business taxes is. It's pretty direct and straightforward for us to estimate the distribution of individual income taxes because we get a return from every income tax paying household in the state. It's a little more difficult, but still relatively straightforward to estimate how much these households are paying in various excise taxes based on the income that they earn. But the taxes that are initially borne by business it's a little less clear exactly who ultimately bears the burden of that. So we use a combination of data and economic theory to estimate how those taxes are ultimately distributed, because businesses don't ultimately pay the burden of the tax. Business tax burdens are passed along to customers in the form of higher prices, workers in the form of lower wages, and capital owners in the forms of lower returns on capital. So in the report, we try to estimate for business taxes how those taxes are distributed among those three factors and what share of the taxes are exported to non-Minnesota workers, customers, and owners of capital. We estimate overall for all state and local taxes that about 15.6% of those taxes that are collected in Minnesota are ultimately exported to taxpayers outside of Minnesota. And the rest are ultimately borne by Minnesotans. So unlike a lot of incidence studies that you'll see, we do include households that don't file income taxes. Oh, Madam Chair.
Senator Weber, excuse me.
Thank you, Madam Chair. One question I have, going back to the list of business taxes and, well, actually, business taxes and taxes on individuals, dealing with property taxes. As we look at the amount paid, what is the increase in that total amount compared to last year's tax incidence study?
Madam Chair, Senator Weber, I do have that comparison a little bit later in the slide deck.
Very good, thank you.
Yep. Okay, so to give as complete a picture as possible about who ultimately pays tax burdens, we do want to estimate the amount of taxes paid by people who don't file income taxes, because every Minnesotan pays taxes in one form or another. Anyone who makes a taxable purchase, anyone who has a car and pays tab fees, and buys gasoline. So we do our best to create a data set of all Minnesota households. So we start with the filer population and people who file a PTR, a property tax refund, but don't file an income tax. But then we add records from administrative records from other state agencies like human service programs that make payments to individuals to sort of round out our population database. And then we create a sample out of that. We estimate that about 12.8% of Minnesota households are not income tax filers, and that about 10.8% file neither the property tax refund or the income tax. So we end up with a very large data sample of about 400,000 records that are blown up to represent the 3 million Minnesota households. The definition of a household is different in our report than in the census. When the Census Bureau talks about a household, that's all the people living in a dwelling unit. For us, it's an individual tax filing unit. So if you have a house with 3 single people who all file their own individual income tax returns, that's 3 households for our purposes. That's 1 for the census. Conversely, if you have a family with a student who's off at school but is a dependent of the family, that's 1 household for us. That would be 2 for the census. So keep that in mind. Okay, so we try to use as broad of a measure of cash income as possible, but because what we're trying to measure is how hard is it for individual households to, or what share of their income is being paid in taxes. So we focus on money income. We start with federal gross income. We include non-taxable cash income like Social Security and non-taxable pension incomes, and other income that we can get data on, including cash payments like the MFIP program. It does not include, importantly, it does not include in-kind assistance like food stamps, housing assistance, medical assistance, and that sort of thing. Those do indirectly help households to stretch their cash dollars further to pay their bills, but we do not have that data built into the database. And when we talk about the distribution among income ranges, that becomes an important factor that I'll talk more about.
Mr. Willett, would you talk a little bit more about how you can have a negative gross income?
Madam Chair, the primary cause of negative gross income is business losses. So people who have pass-through entities that and they have business losses, that's the main result, the main thing that leads to some filers having negative income.
Thank you.
Okay, so I'm going to talk about the results for 2023. A lot of this data does take a while to be received by the department and process. So 2023 is the most recent year that we have kind of a complete picture. So that's what this report focuses on. The previous report we released 2 years ago focused on 2021. So a lot of what we talk about is a concept called effective tax rates. What is my total cash income? What is the total taxes I pay? What is the percent of my income going to pay those taxes? That's what we mean when we say effective tax rate. What this chart shows is it divides the population into groups of 10% of Minnesota's households by income. The first decile is the 10% of incomes with the lowest income, households with the lowest income. The 10th decile is the 10% of households with the highest income. And what this chart shows is what percent of income various households are paying in taxes. The green is the local taxes, the blue is the state taxes. A couple of observations I'll point out on this chart. The big thing that jumps out at everyone is how high the first decile is, and I'll talk about that more in the next slide. The other thing I would point out is that after the first decile, it's a relatively flat system by decile. There's ranges about plus or minus 1%, but kind of very close to a flat system after the first decile.
Mr. Willett?
Yes.
So the suits index for that first decile, that's really impacted, is it not, by local sales taxes, of which we are hearing 30 bills for 30-some communities to make that by their choice, because it's a referendum, but make it even worse, I would say.
Madam Chair, members of the committee, sales taxes and other excise taxes are among the most regressive taxes. That means people at lower incomes pay a higher percent of their income in those excise taxes than people at higher incomes, who tend to take more of their money and put it into investments and non-taxable services and that sort of thing. So yes, indeed, when you increase the amount of sales tax, whether state or local, that increases the regressivity.
What about the impact of property taxes on the suits index as well? Or what percentage of that first decile are people who are homeowners? Do you know that?
Madam Chair, that is in one of the charts in the table. There are not very many homeowners in the first decile. Just their incomes are so low, it's like $13,000 a year or less. But there are some, especially like people with business losses with negative income are often homeowners.
But, Mr. Willett, they are mostly renters.
That's correct, Madam Chair.
So in terms of property tax relief that we give, they would benefit more from, even in this first decile, from increases in the renter's credit that is now noted on an income tax return. Do people who are eligible for that but don't have to file an income tax return, do they nevertheless take advantage generally of the rent credit for filing a return that they're not required to do, but they would get a benefit from the renter's credit, or is that not the way it works?
Madam Chair, members of the committee, so tax year 24 is the first year that the renter credit moved onto the income tax form as opposed to being a standalone program. I don't want to give specific numbers because I don't remember off the top of my head, but I do remember some participation increase from that move.
Okay.
So some people were taking advantage of the program that didn't take advantage of it when it was a standalone program. There was also a simultaneous expansion of eligibility, so the two are kind of intermingled. So that's why I don't want to throw out a statistic that might be wrong.
So would you expect, however, 2 years from now, when there is the next tax incidence study, that would be reflected in that first decile in a different, more favorable way to that first decile in terms of determining the suits index?
So, Madam Chair, In the 2023 data in the report, the PTR is included as a reduction in property taxes, the renter PTR. There is a projection year of 2028 in Chapter 3 where the PTR is moved into the income tax. We kind of debated whether we should leave it in the property tax for comparability purposes, but I do have a slide later on where I compare how it looks in each of the two
Oh, good. I look
programs.
forward to seeing that. Thank you. Senator Drazkowski.
Thank you, Madam Chair. Mr. Willett, you had mentioned that 12% of Minnesotans don't file taxes, income taxes. So how does that fit into or not fit into this first decile, the people who don't file income taxes?
So,
Willett?
Madam Chair and Senator Drazkowski, we do our best to have the first decile reflect everybody in Minnesota who has income lower than whatever the first decile threshold is, 13,000 or something like that. So we do that by collecting, by having a data sharing agreement with other agencies that send us data on human service program recipients. So we can augment our filing records with these other households that are not filers. And so in that way, we have records that represent these households that are not filers in our database based on the income data that we can collect, the MFIP payments or other sorts of benefits they're getting from the state. It's not comprehensive, but it is, but we then scale the records we do have to match what we think the number of people in that category is based on other population data.
So,
Senator Drazkowski.
Madam Chair, thank you. So, Mr. Willett, how reliable do you think that data is? I mean, when people are filing income taxes, they actually have to report their income. Many of these welfare programs, they're self-selecting their income or self-reporting their income. Do you have concerns about the reliability of that data?
Mr. Willett.
Madam Chair, Senator Drazkowski, I'm not an expert in how the various human service programs work. My understanding is that generally the ones with the income eligibility do have some sort of income verification. I don't know exactly how that's done or how reliable or rigorous it is, but we take on faith the data that we get from those programs.
Senator Drazkowski.
Thank you, Madam Chair. Thank you, Mr. Willett. It just seems disjointed. You know, in some of these welfare programs, they self-attest in order to fit into the qualification for the program. So anyway, I just, it might be worth some analysis. It just doesn't, it seems like two different sets of data to determine their income, and that may maybe attribute to what you're seeing in this particular chart.
Madam
Thank
Chair,
you.
Senator Drazkowski,
Yeah,
thank you.
Thank you, Senator Drazkowski. Senator Nelson.
Thank you, Madam Chair. Property taxes are really front and center for many of our constituents right now. And I know we've spent a lot of time on this slide, but I have one more question that I don't know if you could answer it, but maybe there's some data in here to help answer that question. The idea is we're specifically thinking about the first decile of earners, and we see the effective tax rate being so high. And one of the most important things, obviously, is having a place to live. And so we talked about the renters tax credit, and then we also talked about property tax relief, and we have different ways to address both of those. But my question is, I'm trying to understand what is most effective for that first decile when we're talking about property tax relief. Is it reducing, is it a property tax credit, which you have to apply for it, and maybe some people do and some people don't, or as we think of property taxes that are so forefront with Minnesotans' minds, when it comes to rental properties, those property taxes, I would assume, are already calculated into the cost of the rent. And so what's most effective for that first tier? Is it keeping those property tax lower, which, I mean, helps everybody, but specifically keeping those first decile property rents lower because of the property tax being lower, or is it more helpful with the renter's tax credit? And do you have any insight on that, or maybe direction to I know it's a philosophical issue too, but I think it's important to understand what's more effective and where would we see the biggest impact?
Mr. Bullitt?
Madam Chair, Senator Nelson, it is an excellent and very difficult question to answer. So a couple observations I would make is, the renter refund goes directly into the savings accounts of the people doing the renting. General relief for rental property owners goes to the intermediary, who is the owner, who's paying the initial tax bill, but then passing that along either to the renters or reducing their return on capital. And it's likely a mix of the two, but that depends on the competitiveness of the market and all the other economic factors that a business owner has to weigh. But if you have a very generous and really broad direct support program, that essentially reduces the price of the market. So that is also going to have a general effect on the cost of renting in the market. That's why I hesitate to give you a firm answer. I don't think I'm qualified to.
Madam Chair.
Senator Nelson?
Thank you for the thoughtful dialogue. It is difficult to try and assess out where it's going to be the most impactful, keeping the rents lower through lower property taxes or through the renter's tax credit. So I thank you for your insight on that. We'll just have to keep noodling on that.
Thank you, Senator Nelson. Mr. Willett, or Senator Weber.
Thank you, Madam Chair. Mr. Willett, I've been dealing with tax incidence reports for a few years now, and so I don't envy your job of having to put this together. But on page 18 of the larger report, the final statement that is made regarding the effective tax rate in the first decile is that for all these reasons, effective tax rates in the first decile are overstated by an unknown but possibly significant amount. Could you expand upon that, please?
Madam Chair, Senator Weber, thank you. That actually leads perfectly into my next slide, which is all about the first decile. So I appreciate that. When we compare to the 2021 report, or the previous report, which looked at 2021, you'll see that first decile effective tax rate really jumped, much higher than it was in 2021. So the reason that we have that statement on page 18 is because there's a couple of really important reasons we think that the actual burden in the first decile might be overstated by these statistics. The first decile does include people who are temporarily low income, those people with business losses. There are only about 9,000 or so of the households in the first decile, but they average negative income of about $112,000. So a lot of the taxes being borne in the first decile actually are paid by those households. And some of them may be in dire straits if they have that much business losses, but for some it might just be a cyclical part of their business where they're having a down year, but their overall ability to pay is not completely diminished. So that's one reason why we think you should take the first decile results with a grain of salt. The other one is one that I mentioned earlier, which is the in-kind income not being included. Those in-kind supports like SNAP food benefits and housing assistance and medical assistance don't show up in the income, but they allow the income that those households have to be stretched further because they don't have to spend money on food or as much money on food and housing and medical and that sort of thing. We talked about this when I presented this to another body a couple weeks ago. So we're trying to put information together to roughly estimate how much income we're talking about from these programs. It looks like for the big ones that we could easily identify, it's about $1.5 billion. That's not all going to be in the first decile, but a good chunk of that is going to be in the first decile. And if you look at table 2.2, the total amount of income in the first decile is only $2 billion. So if you were to add a good chunk of that $1.5 billion to the first decile people, that reduces that effective tax rate quite a bit. So that's why we say, yes, it is higher because the taxes are regressive. Poor people are going to pay a higher share of their income in excise taxes and property taxes, but it may not be twice as high as the next decile if we were able to perfectly take into account these other factors. Does that help?
Okay.
Senator Drazkowski?
Thank you, Madam Chair. So, Mr. Willett, does the welfare income, is that counted as income then in the calculation for those people that you're using that alternative data for, or is it just their reported wages, et cetera?
Madam
Willett?
Chair, Senator Drazkowski, the cash programs we include, the ones that are actually money that could be spent to pay a tax bill, we include in the income. The in-kind income, which is like a voucher for food or for housing, we do not include because that's not liquid cash.
Okay, thank you.
Senator Nelson?
Thank you, Madam Chair. Just one more brief question. It's such interesting discussion. Do you know if there are other states that, in trying to get a more accurate look at that first decile, are there other states that do include the value of those non-cash subsidies in their income as they're determining that?
Mr. Willett?
Madam Chair and members of the committee, well, the first part of the answer is that very few states undertake this challenge and create a report like this. Some have done it as a one-off. Only one other state, and I can't remember which one, also does a regularly scheduled tax incidence study of this magnitude. So that's a hard question to answer, but all my colleagues around the country attempt to do these sorts of analyses, you know, when questions are posed. So I'm not sure how many of them have the ability, because of data practices laws or staff capacity or whatever, to build a database like that. As I said, we are trying to rough out what inclusion of the in-kind income would do to the effective tax rates. We don't have microdata, but we can see what the income eligible ranges are and sort of, you know, spread it out and see, you know, how much would that 36.6% drop roughly. So if we feel confident we have an answer worth sharing, we will share that with all of you.
Thank you. Thank you, Madam Chair.
Thank you. Mr. Willett?
Okay, so the chair mentioned the suits index. The suits index is a general mathematical way to measure, is a tax system overall progressive or regressive? What that means is regressivity means people with lower incomes pay a higher percent of their income in taxes. A progressive system means people at lower incomes would pay a lower percent of their income in taxes. Virtually every state and local tax system is regressive. Because of the taxes that states use, most states have more regressive taxes than progressive taxes. Minnesota is very close to proportional. Our overall suits index is negative 0.029. If you look at the star on this chart, it's almost proportional. -1 would be a perfectly regressive system, which would mean the poorest person pays all the taxes. 1 suits index means the richest person pays all the taxes, or the highest income person. Clearly, neither of those is based in reality, but suits indexes are generally, you know, a lot closer to 0. But the more negative it is, the more regressive it is.
So, Mr. Willett, when you are using the year 2023, does that include the 2023, the impacts of 2023 tax bill?
Madam Chair and members, it includes the parts of the 23 tax bill and transportation bill that were in effect for tax year 23. So like the moving the renter credit into the income tax form didn't happen until 2024. So that's still in the property tax side. Some of the local sales taxes that have been enacted weren't actually implemented or had just started being implemented in 2023. Dollar-wise, the most significant ones were the 2 metro-wide sales taxes. Those started in October of 2023, and because there's a month delay in the sales tax refunds, there's only 2 months of the metro sales tax in this year. When we look at the projection year of 2028, you'll have a more robust look at all those cumulative impacts.
Mr. Willett, I think we'll be very interested in the 2028, or some of the people here will be interested in it. I probably won't, but or Senator Drazkowski or Senator Miller or some others will be less interested because we'll be engaged in other activities. Go ahead.
Okay, Madam Chair, I'm going to try and pick up the pace a little bit so that we can get
Yes,
through things. So this is just a visual representation of all of our various state and local taxes, how much money they raise and how regressive or progressive they are. The size of the bubble is the relative size of the dollars raised. How far to the right or left it is representative of how regressive or progressive it is. What you'll see is that the income tax is both our largest tax and one of the few taxes that's on the progressive side of the axis. The other progressive taxes are the estate tax and the property tax refunds, which aren't a tax in and of themselves, but are a tax policy that is very, very progressive. Everything else is on the left side of the middle axis, meaning it is a regressive tax to greater or lesser degrees. Some are just a little bit regressive, like residential property taxes and the corporate income tax. Some are much more regressive, like the tobacco tax and motor fuels taxes and gambling taxes. If you're a visual learner, this is a way to think about how regressive or progressive our various taxes are. Okay, here's that same effective tax rate chart by decile, but it breaks it into different types of taxes. What you'll see is that the individual income tax, which is our largest tax, is actually negative in the lower three deciles, which means the people in the lower three deciles get more refundable credits than they pay in income taxes as a whole. There are people in those three deciles who are paying positive income tax bills, but collectively that lower 30% of Minnesotans are actually getting a positive cash benefit from the income tax system. The further to the right you go, meaning the higher the incomes of individual households are getting, the more important that property tax is as a share of the total taxes that they pay. And again, this is as a percent of income. This isn't gross dollars. So the income tax, you'll see, is the only one where the bars get bigger as you move to the right. All the rest of them, being regressive taxes, get smaller as you move to the right, meaning the tax is a smaller percent of income the higher your income is on average. You'll also see I added dotted black lines for the first three deciles, and that's where the net total is if you were to take the negative income tax and subtract it from the top of the positive bar. So those dotted lines match the totals from the previous chart. So importantly, sales taxes, you see the really big green bars in the first few deciles. That's a really important contributor to the taxes paid at those lower income levels. And that's both state and local sales taxes. Conversely, refundable credits and property tax refunds are among the most progressive tax policies we have in our tax code. The child tax credit and the working family credit, which were significantly expanded in 2023, are a very large dollar amount, over $700 million, and also very concentrated in lower income households. So they have a positive suits index of positive almost 0.9, which is an extremely progressive measure of the suits index. The dependent care credit and the K-12 education credit, much smaller programs and not quite as progressive, but still very progressive. And then the property tax refunds, as we talked about, especially the renter refund, which has a pretty limited, a very low income ceiling, is a very, very positive suits index of 0.875. The homeowners property tax refund, $900 million, so 3 times as large in 2023. Not quite as progressive, but still a positive 0.6, which is a very, very progressive measure. Looking at the property tax refunds visually, this shows homeowner property taxes, what the effective tax rate by decile would be without the PTR, which is the top blue line, and what they are net of the homeowner PTR. So you can see at the lower deciles, the property tax refund is a very effective program for reducing the effective tax rate for homeowners in the lower deciles. You can see several percentage point drop in the effective tax rate from the property tax refund. The higher up the income scale you get, the fewer homeowners that are eligible for a PTR, and the size of the PTR gets smaller. So it has a diminishing power to reduce the effective tax rates the higher up the income range you go. And at the very highest income ranges, the homeowner PTR has very little effect. There is the targeted program, which does not have an income cap, which has a very tiny impact at the top deciles.
Senator Hemmingson Yager.
I'm just curious, so you mentioned that a couple slides back that the lowest decile was mostly renters. And then on this slide, you're saying, but for those who are homeowners, it has a very drastic impact on their effective tax rate. Do you happen to know kind of like how the number of households are correlated with each decile? Or homeowners, yeah.
Yeah, so that is in the report. It might take me a minute to find it, but we do have a table that shows homeowners and renters separately by decile. In the interest of time, maybe I can just answer
Totally.
that question
Yep,
for
thank you.
at the end. But yeah, we do have that data in the report. In Chapter 4, we have an alternative way to look at the data. Most of the report is focused on population deciles, which means there's an equal 10% of households in each decile. An alternative way to think about incidence is by income deciles, where you take households and you take all the households that make up the lowest 10% of income being in the first decile, all the households that make up the top 10% of income in the in the 10th decile. What this chart shows is how those two compare in terms of numbers. So in the bottom 40% of households make up the bottom 4 deciles on the population side, but the bottom 41% of households are all in the lowest income decile. And in other words, the lowest income 41% of households have 10% of Minnesota's total income, whereas the top population decile has 10% of the households, but has 43% of the income. The top decile in the income deciles has only 1,500 households, so almost 0% of the households, but does have 10% of the income. So we have some of the distribution of taxes in the report distributed this way. The advantage of the income deciles is that you can get more detail at people at the upper income, whereas the population deciles gives you more detail of people who are in the lower income deciles. So depending on what question you're asking yourself, one table might be more useful than the other. And this just compares what the effective tax rates are like between the population deciles and the income deciles. Keep in mind there's different numbers of households in the first decile for the two different groups and the 10th decile. So one thing you'll see is the first income decile, which again is 41% of the households, has a 14.1% effective tax rate. So that really big effective tax rate is really concentrated in the lowest income people. But when you average out the lowest 40%, that gets us to look like an even more proportional system. 14% in the first decile, 11.9% in the 10th income decile. Just an alternative way to look at the data. We also, on pages 82 to 93, look at demographic variations. So there's tables that break out different types of households. So we divide the population into 6 different types of households: married with children, married couples without children, married seniors, single parents, single non-senior, and single seniors. One of the things I want to impress upon you is look at the median income differences among these household types. A really significant gap between the incomes of married households and single households. Married with children, the median income is $150,000 with a 12.2% effective tax rate. The median single senior has an income of $39,000. And then you can also see the suits indexes on the right. Most of them are regressive. Single parent is the only group that overall has a positive suits index, and that's mainly because of the generous refundable credits that Minnesota has built into its tax code. Okay, really quickly, I just want to put the 2023 results into the context of the last report that I presented 2 years ago. Remember, the last report was focused on 2021, which was kind of the heart of the pandemic. So our economy was a little bit different in 2021 than it was in the study before and the study in 2023. You may remember me saying in the last report that 2021 had the most concentrated income at the top end that we had ever seen since we started doing this report. As we expected, that moderated somewhat in 2023, still higher income concentration than we've seen in studies before the previous one, but not as concentrated as 2021. The main reason for that is 2021 was a record-breaking capital gains year, which the benefits of that are concentrated in the upper income deciles. We still had very high capital gains, historically speaking, in 2023, but it was nothing like the 2021 capital gains. The other really important difference between 2021 and now is that at the lower end of the income spectrum, there were some important income supports in 2021 that no longer existed in 2023. There were the economic impact payments that were being made by the federal government. That put a lot of money into the pockets of lower income households as a percent of their total income. Unemployment payments also were a very significant source of income in 2021. Those have obviously moderated as the economy has started to move past the pandemic. Also, inflation is moderated, but it is still high by historical standards. So all these effects mean that the total amount of income in the first decile was actually lower in 2023 than in 2021 by like 33%. So when you take a third of the cash income out of the first decile, that's what's going to drive that effective tax rate up to be so high in 2023. Another way to think about it is that the effective tax rate was sort of artificially low in 2021 because of those one-time income supports that were in existence. So 2018, the first decile effective tax rate was something between what we see in this report and what we saw in the previous report. So it kind of went down and then went up again. This is a historical look at income distribution by income range. The top bar is the top 1% of household income. And 2021, which is the third from the right, was the last study. And you can see that 19.1% of the income was in the top 1%. And that was a historical high point. And the fact that the lower 80% had only 40% was also a historical low point. It's moderated somewhat in 2023, and we think it's going to continue to moderate a little bit when we look at projection year 28. So here's those. So we're going to really quickly talk about the income changes in the last couple of years, then the tax changes, which Senator Weber was talking about. So between 21 and 23, overall wages grew a healthy 10.8%. Retirement income grew a lot. We're kind of in the peak of the retirement wave between 21 and 23. Business income was growing, but only a little bit. And that capital gains and investment income was what really pulled back in 23. The unemployment went from a historic high of $4.5 billion down to more typical $800 million. And those economic impact payments, which were almost $9 billion of income, a full 3% of all income in Minnesota in 2021, went away, obviously, in 2023 with the pandemic being behind us. Similarly, the tax changes, you'll see individual income tax was relatively flat. Remember, income tax is a little bit of a volatile tax, so it bounces up and down a little bit with a general increase over time. The way we measured it in the two reports, it ended up being about flat. But again, the general trend is growth. We just didn't have much growth in this particular snapshot. The homeowner and cabin property tax is up 16%. That's 8% a year. That's a lot. But the individual sales and motor vehicle taxes is where the big increase was, over 20% increase in that 2-year period. Some of that was tax policy changes, as the chair mentioned, but some of it was just consumption changes as well. Coming out of the pandemic, some people having an increase in wages and spending more on taxable goods than they had been in 2021. Comparing the effective tax rates, generally effective tax rates went up in all deciles except the third between 21 and 23. A lot of that had to do with the tax increases growing more quickly than the income did. Anytime taxes grow more than income, effective tax rates are going to go up. That decrease in the third decile primarily because of the new child tax credit, which benefits generally the lower 4 to 5 deciles, but really the biggest payments and the biggest impact on overall income hit that third decile, just because of where the children are and where the eligibility is. This is a history of the overall effective tax rate. We're at 12.2% in 23. We were as high as 13% when we first did the study. It went down. It's gone up and down a little bit over the history, but really has generally been between 11.2 and 13% over the entire history of the report. So some up and down, but the price of government, if you will, has been relatively stable over time, which means taxes have generally kept pace with income growth. The suits index actually went down a little bit since the last report. It's the lowest it's been since 2024. Not a big change, negative 0.23 to negative 0.29. In the scope of what we see in suits indexes, that would be considered a slight change, but it is a change down. We were expected to remain relatively unchanged into the projection year of 2028. While there were policy changes in 23 that had an impact on this, it was really the change in income distribution that had the bigger impact in the regressivity. And I'll add a little bit more to that in a minute. Here's the history of the suits index. You see it has wavered quite a bit over the years we've done this. Policy changes have had an impact on these changes over time, but economic changes are almost always the more powerful factor. Tax policy is really important, but the economy is even more powerful than the decisions that are made on tax policy in terms of the ultimate distribution of taxes. So I did want to talk a little bit about the 2023 changes because I know that's of high interest. You may remember in 2023, there was a lot of significant tax policy change. Most of the tax policy that was in the 2023 tax bill was very progressive. The creation of the child tax credit, the faster phase out of standard and itemized deductions, the net investment tax for investments over $1 million. Those are all very progressive tax policies. So our income tax got much more progressive from those policy changes. On the other side, a lot of the very regressive tax policy changes were in the omnibus transportation bill and the housing bill. That's the metro sales tax. That's the other transportation-related taxes, indexing the gas tax, changes to the registration taxes. Those were all relatively regressive tax changes. The tax bill did also have some local tax authorizations, I believe, which would have been the regressive part of the omnibus income tax. At the time, we did an incidence analysis of those changes, which I can provide to the committee if you don't have access to it. It's still on our website. What we found was those changes in isolation, if you hold the economy constant, were on net progressive. So between all those changes, they made the system more progressive. But when we look at the actual change from 21 to 23, the system got a little bit more regressive because of those economic changes, especially the reduction of income in the lower deciles from the end of the economic impact payments and some other factors. Okay. So I'm going to talk a little bit about the projection year real quickly. So there were not a lot of significant tax changes since 2023 that show up in the tax projections. We did increase the cannabis gross receipts tax from 10% to 15%, made a portion of the corporate research and development credit refundable, eliminated the sales tax exemption for electricity for data centers, and then a couple of things from 2023 that hadn't fully phased in, the metro sales tax, some of the other local taxes that hadn't been enacted yet, and then the renter refund moving from the income tax system, or from the property tax standalone program into being part of the income tax system. So comparing 23 to our projections in 28, total income over those 5 years, a 20% growth. Tax collections, which are based on the state forecast, not the most recent one. This report takes us quite a few months to put together, so it's actually based on the November forecast. So we see tax collections increasing 22% overall, which means a small increase in the effective tax rate. Again, anytime taxes grow faster than income, effective tax rates will go up. Anytime the converse is true, effective tax rates will go down. And virtually no change to the suits index that we're projecting. Here's income changes by decile. We lumped the first 4 deciles together because they had pretty similar results. The main thing I want to point out is the income. So there's the overall income change, the income tax change, and the total tax change. You'll see a very large change in the income tax in the first 4 deciles, but I want to specifically talk about that because that percent increase is actually a negative getting more negative. So remember, the first 3 deciles, the income tax is negative. There's actually dollars going to the households rather than coming from the households to the state. And that negative several $100 million we project is going to get even bigger from 23 to 28. Part of that is the renter's credit moving into the income tax system. So So even though it looks like a big positive percent number, that's actually payments to lower income households getting bigger, so a negative income tax. Apologize for the complexity of that math, but that's just how it worked out. And you can see the changes in the upper deciles are a little bit more consistent, where income and income taxes and total taxes are changing in the 20% range for virtually every decile. So here's that slide I promised on the move of the renter property tax refund from being part of the income tax to part of the property tax to part of the income tax, I'm sorry. So what you'll see is the first two columns on the left shows what effective tax rates are by decile with the renter PTR included in the income tax, which is as it's shown in the report. So you'll see the first decile has a negative 7.6% effective tax rate on the income tax. The property tax is 8.9% effective tax rate, whereas on the right-hand side, if we had left the renter credit as part of the property tax calculation, the income tax for the first decile would have been negative 5.7%, and the residential property tax would have only been a positive 6.9%. So that roughly 2%, that's the value of the renter credit, is moving from being a reduction in income tax, a reduction in property tax on the right, to a reduction in income tax on the left. And you can see the converse effect in the upper deciles. Okay, I'm getting close. This compares the effective tax rates from 23 to 28. You are seeing that those negatives in the lower deciles, that a lot of that is because of the move of the, well, no, it's not because of the move of the renter credit. That has no overall impact to the effective tax rates. That's because of our projection of where income is going to grow and where taxes are going to grow. So not a big overall change, but generally small reduction in effective tax rate at the lower end, increases in tax rates at the upper end. And my last thing is a comparison of Minnesota to other states. So as I said, other states don't do this kind of study, so we don't have a perfect comparison. But we did use data that was part of another study by an organization called ITEP that had the raw data collected from all the states to make us do a rough suits index for all states. And we had a consultant help us put this together. But what it basically did, it looked at income by quintile rather than decile, so groups of 20% of the population rather than groups of 10% of the population. And it enabled us to not quite so precisely do the suits index as we do it, but it made us able to do an apples-to-apples comparison among states. So the results of this aren't perfectly comparable to our report, but we think it's a fair way to compare one state to another in terms of how progressive or regressive each state's tax system is. And I'll just jump to the highlight. Minnesota has the second highest suits index of all the state and local systems by this measure, just a little bit behind Vermont. Here's a chart comparing Minnesota to the three most regressive state and local tax systems in the country, which are Florida, Texas, and Washington, and you can see the suits indexes in the box. Minnesota is the one that's going from lower on the left to higher on the right. That's the sign of a more progressive tax system, whereas the others are going from higher on the left to lower on the right, which is a sign of a regressive tax system. The lowest 20% paying a higher percent of their income in taxes than the upper income folks. The main feature that causes this is that those three states do not have a personal income tax. Remember, I said the personal income tax is generally the only large progressive tax that states implement. And when you don't have one of those as part of your tax system, you're going to have a more regressive tax system. The final chart compares Minnesota to our neighbors. Minnesota is the one that is the lowest on the left and the highest on the right, which is a good sign that it is the most progressive, and the suits indexes in the box bear that out. But our Midwest counterparts are not as regressive as the states we saw on the previous screen. That is the end of my presentation. There's a lot more information in here. I encourage you to look at it as you can and throw any questions you come up with our way.
Thank you so much, Mr. Willett. We may come back to this this report at a future date, so I hope you'll be able to join us again. It's a lot of fascinating information that we can use to guide our tax policy in the future. Thank you very much.
Madam Chair, members, thank you very much.
Members, we're going to move to to Senate File 4787. Ms. Bears will probably not get to the technical and policy bill today because there are so many testifiers on 4787. We want to spend as much time that we have left on the bill with testifiers from other places, okay? So Senator Housechild, if you would chair for this bill, and if you would, we want to have everybody be able to speak, so if you would limit their testimony for 2 minutes, my presentation will be like 30 seconds. Okay.
Welcome to the committee, Madam Chair. Looks like we have Senate File 4787. Please proceed with your testimony.
Mr. Chairman, I have an A2 amendment, author's amendment, please.
Okay, Senator Rest introduces the A2 Authors Amendment. Those in favor, say aye. Aye.
Aye.
Opposed, nay. The A2 is adopted. Senator Rest, to your amendment and the underlying bill.
Thank you. This bill has actually just 2 sections. One is to, the first section just applies sales tax to advertising, and you will find that on page 4, line 415. And then the section 2 is an attempt to define what is meant by advertising services, and that comes, and that's the heart of the A2 amendment, with one other thing, changing it the beginning from June until, beginning of it from June until September. Also, there is there's an attempt to neutralize the impact on in Section 3 on tobacco taxes. I'm concerned about that we're increasing the sales tax, but then we're excusing the reduction in the rate, but not for tobacco. And I'm not sure that whether that is possibly a violation of streamline. So we'd be keeping on looking at that. This bill is a companion to a bill that was heard in the House, and we, I thought it was an interesting enough discussion over there that we should have it over here. So Senator Dibble and I introduced this bill, and that's all the comments I have for it. I'm going to sit in a chair here so that you can bring up the 3 testifiers at a time. Okay?
Yep. Thank you, Madam Chair. First up, we have Mr. Eric Bernstein, Brian Cook, and Paul Eager. If all 3 of you would be willing to come up just so we can kind of move through testimony, that would be very helpful. Or at least two of you, yeah. Okay, Mr. Bernstein, if you could introduce yourself for the record and go ahead with your testimony. We're going to try to limit things to 2 minutes if possible. Thank you.
I'll move quick. Chair, House-Child, members of the committee, my name is Eric Bernstein. I'm the director of We Make Minnesota. We're a coalition of labor and community groups united in support of a fair tax code and a budget sufficient to meet the state's public investment needs. Thanks for the opportunity to share our support for 4787, which would end the sales tax exemption for advertising while preserving exempt status for print, radio, and television. This bill represents a vital update to a sales tax code that was established at a time when consumption of tangible goods represented the bulk of commercial activity. Today, we have a largely service-based and increasingly digital economy, but our sales tax base is not kept up. With sales tax exemptions totaling over $10 billion in 2026, Minnesota now excludes more of our total potential sales tax base than we include. The result of this porous tax code is that we raise less revenue for each percentage point. In 2021, South Dakota raised 30% more money per capita with a rate that was 40% lower. They do that by applying this lower rate to a larger base. Our current sales tax is particularly unfair to manufacturers, builders, and retailers who pay sales taxes on their inputs and who sell taxable products. In total, Minnesota businesses shoulder 48% of our statewide sales tax burden. It's just concentrated on those industries. I underscore that because I know that opposition to this bill focuses substantially on the opposition to business transactions. In reality, we do tax a very large number of B2B transactions. We just limit it to certain areas. In tax policy, special carve-outs like that are always ill-advised, but they're especially questionable, I think, in this environment with social media companies and large advertising platforms. Online advertising revenues exploded in recent decades from $8 billion in 2000 to more than $258 billion last year. That's 30 times the rate of economic growth overall. And about 2/3 of that online advertising revenue was held with just 5 firms: Google, Amazon, Meta, Microsoft, and TikTok. On the other side of the ledger, the largest advertisers are also very large conglomerates. Firms like Comcast, Verizon, Procter & Gamble, they spend anywhere from $1 to $5 billion on advertising. So that's really who's going to be impacted by this tax. Exempting this industry from sales taxes while so many others pay in is an unjustifiable subsidy to these large corporations. I highlight this in particular because a lot of the opposition to this bill will be dressed up as defense of small business or of entrepreneurship. There's nothing pro-competitive about furthering monopolistic advantages through preferential tax policy. Finally, and importantly, SF 4787 would not just raise $300 million, it would also reduce the state's sales tax rate by 0.125 percentage points. This will reduce the tax burden on families who don't buy billboards or online ads, but spend plenty on taxable meals out, school supplies, home goods, and other things. It will do that while providing revenue for the services they rely on. That's a win-win. It's past time we adopt a modern tax code, and so we hope you'll support this bill. Thank you.
Thank you. Next, we have Mr. Brian Cook, and then I'm just going to call up Deb Peters to be on deck for the third spot. Mr. Cook, if you could introduce yourself and go ahead with your testimony.
Great. Good morning, Vice Chair House-Child, members of the Senate Taxes Committee. My name is Brian Cook. I'm the Director of Tax, Fiscal Policy, and Elections for the Minnesota Chamber of Commerce. Chamber represents more than 6,300 businesses of all sizes in all corners of the state with more than 500,000 employees. I'd like to note that more than 75% of our members are small and medium-sized businesses with less than 100 employees. Appreciate the opportunity to share some of our concerns with Senator Rest's Senate File 4787 as amended by the A2 amendment, which would expand the state's sales tax to certain primarily digital advertising services. Maryland was the first state to pass a digital advertising tax, and since its enactment in 2021, it has been mired in litigation related to the Internet Tax Freedom Act and the Commerce Clause. Like in Maryland, enacting a digital advertising tax would be a risky proposition that could create additional budget pressure and uncertainty if it were overturned. As a sales tax, the cost will be borne by the purchasers of these advertising services in Minnesota, who are businesses of all kinds and all sizes, increasing the cost of operations and likely ultimately being passed along to Minnesota consumers. While the bill does cut the general sales tax rate, it would still be at a minimum a 6.375% cost increase for these services. And that's a baseline minimum since local sales tax rates would also apply and would be over 9% in the really high tax cities like St. Paul and Golden Valley. Expanding the sales tax base to also include certain professional services related to advertising will also have a negative impact on Minnesota companies who provide those services and place them at a disadvantage to out-of-state competitors. Minnesota already ranks among the highest tax states for both individuals and businesses. Instead of closing the gap with our peer and neighboring states, this legislation would widen it. We urge you to reconsider this approach and instead prioritize policies that strengthen the long-term economic viability of Minnesota through growth. Thank you very much.
Thank you, Mr. Cook. Next, we have Mr. Paul Eager, and in the third spot on deck, we have Mr. Dalton Danielson, if he could come up. Go ahead with your testimony.
Mr. Chair, members of the committee, my name is Paul Egger, and I'm Senior Vice President of Governmental Affairs for the Minnesota Realtors Association. Thank you for the opportunity to testify today on behalf of our 21,500 real estate salesperson and broker members to respectfully oppose Senate File 4787, which would impose a sales tax on certain advertising services. The overwhelming majority of realtors are independent contractors. They are small business owners and entrepreneurs who pay their own expenses, cover their own marketing costs, and take on their own financial risk. As small business owners, investing in advertising is critical to generating clients that translate into income. Some typical advertising that realtors engage in that would appear to be taxed under this bill include marketing a seller's home on the multiple listing service, paying for online listing promotion on real estate websites, search engine marketing to ensure listings are visible to buyers, social media advertising for open houses or new listings, professional graphic design, which is editing photos, videos, and virtual tours for marketing materials, neighborhood signage and directional ads associated with listings, subscribing to referral networks, such as relocation companies, using customer relationship management tools, which are email, text, follow-up systems, and using tools like Google Analytics to track website behavior to understand their marketing effectiveness. Expanding the sales tax to advertising services will increase operating costs for our members. This will have a regressive impact that will disproportionately affect newer realtors and smaller brokerages who rely more on advertising than established realtors who have a strong business of repeat buyers and referrals. This will also result in more costs being passed on to consumers and will likely mean reduced marketing campaigns, which may limit realtors' ability to promote homes as effectively as they do currently, negatively impacting sellers and decreasing buyers' exposure to homes that best fit their needs. Thank you again for the opportunity to share how Senate File 4787 would impact our members and their clients.
Thank you, Mr. Eager. Up next, we have Ms. Deb Peters, and on deck for the third spot is Mr. Tanner Fritzinger, if he could come up. Go ahead with your testimony. Thanks so much.
Good morning. My name is Deb Peters. Good morning, Madam Chair and Mr. Chair. It's really hard to be an opponent to a good friend for 25 years, so I apologize. Today I'm representing the Americans for Digital Opportunity, an organization powered by the Internet Coalition, to express our strong opposition to the Senate File 4787. As you've already heard, this bill would impose a tax on digital and non-digital advertising services with the exception for print, radio, and TV ads. Not only does this raise serious legal concerns, but it picks winners and losers in that environment. But the real concern is the local businesses, the retailers, and the businesses of all sizes, as well as your Minnesota consumers would feel the biggest impact because it's a pass down, it's a trickle down. Widening the base while lowering the rate is an admirable goal. It must be done equitably and fairly, but this bill does not do that because it picks the winners and the losers. Advertising is one of the most effective and affordable tools, as you've heard from the realtors in the Chamber of Commerce, that really impacts your businesses. They use this to reach their consumers and their customers and to stay competitive. Taxing advertising and advertising-related services raises costs for everyone that participates. Increasing expenses by levying new taxes will only trickle down to the smaller local Minnesota businesses that are using these tools to tell their story and to grow their consumer base. They'll feel the repercussions, and by reducing the small business opportunity to tell their story and to put their name on the map, it will in turn reduce their foot traffic, reduce their sales growth, and reduce their income tax payable to your state. The economic impact in Minnesota could be significant. Advertising supports over 550,000 jobs here and drives over $200 billion in economic activity across the state. This bill threatens all of that activity, and it is the last thing we should be doing given the lingering impact of inflation and our global uncertainties. In addition to the economic harm, Senate File 4787 raises serious legal concerns, as we've heard from the Chamber. It risks violating the Permanent Internet Tax Freedom Act by levying discriminatory taxes on electronic commerce. And with that, I'll close by saying, please reject this idea by taxing the very tools that help your small businesses and your constituents thrive. Thank you, and have a good morning.
Thank you so much, Ms. Peters, and I just want to thank everybody for really sticking to the times. It's been very good so far. So up next, we have Mr. Dalton Danielson, and on the third spot deck, we have Ms. Kirsten Morcom. Go ahead. Thank you so much.
Thank you, Mr. Chair. Members, my name is Dalton Danielson, Fiscal Policy Director with the Minnesota Business Partnership. MBP represents CEOs and senior executives from Minnesota-based companies across healthcare, manufacturing, agriculture, financial services, and technology. Our members employ 1 in 6 Minnesotans statewide and compete every day in national and global markets. The Minnesota Business Partnership strongly opposes Senate File 4787. At its core, this bill imposes a sales tax on business input, not final consumer purchases. Advertising, particularly digital advertising, is overwhelmingly purchased by businesses to sell goods and services that are already subject to sales tax. Taxing these inputs embeds hidden taxes into prices that are likely to be passed on to consumers. And for clarity, members, Senate File 4787 will impact every business across Minnesota, not just a narrow segment of the economy. While the bill is often described as targeting large technology companies, advertising is a critical tool used by manufacturers, retailers, healthcare providers, nonprofits, and small businesses alike. This proposal would raise costs across the board, affecting both Minnesota's headquarters economy and Main Street businesses trying to grow and compete. In addition, and as has already been stated, Senate File 4787 raises serious legal and administrative concerns. Digital advertising transactions routinely cross state lines, involving advertisers, platforms, servers, and audiences in multiple jurisdictions. Taxing these transactions without a clear and workable sourcing framework exposes Minnesota to Commerce Clause challenges and the risk of multiple taxation. Similar taxes in other states are already being litigated, putting projected revenues at risk. Finally, members, Minnesota's economic strength depends on a tax system that is neutral, transparent, and competitive. We respectfully request the committee to oppose Senate File 4787 and instead prioritize policies that promote economic growth and sustainable, predictable revenue. Thanks.
Thank you, Mr. Danielson. Next, we have Mr. Tanner Fritzinger, and on deck, we have Mr. John Beshy.
Thank you, Chair Hochschild and members of the committee. My name is Tanner Fritzinger, and I am a political affairs coordinator with the Minnesota Association of Professional Employees. We are a labor union representing over 18,000 state workers across all agencies, boards, and commissions. Thank you for the opportunity to testify in support of Senate File 4787. MATE members work in all segments of state service, whether it's ensuring that our food and water supply is safe, providing a better life for our military veterans, or even taking care of the animals at the Minnesota Zoo. MATE members are a significant contributor to the high quality of life that is enjoyed by Minnesotans. Currently, the state's forecasted structural imbalance threatens Minnesota's ability to continue to deliver these services and programs that our neighbors rely on. Repealing the tax exemption on advertising services is a helpful step in addressing the structural imbalance, creating parity in advertisement tax policy, and raising the revenues needed to continue to deliver the essential services in the state now and into the future. Senate File 4787 is a meaningful proposal that would raise revenue from an industry that continues to experience massive growth. This legislation's inclusion of taxing digital advertising on online platforms such as Facebook or Google, in addition to the taxation of advertising on billboards, is essential in broadening our tax code to include more modern streams of revenue. As the cost of delivering essential state services continue to rise and strain our current resources, modernizing Minnesota's tax base to include emerging industries is the forward thinking required to continue to deliver the programs that MATE members administer. Senate File 4787 is a step in the right direction, and we ask that members of the committee support its passage. Thank you.
Thank you, Mr. Fritzinger. On deck, we have somebody online, so we'll go to Ms. Kirsten Morcom. If you could introduce yourself and go ahead with your testimony.
Hi, Chair Hauschild and members of the committee. My name is Kirsten Morcom, and I'm a teacher at the Bloomington Public Schools. And I'm here today to testify in support of Senate File 4787, which would raise revenue for our state by taxing ad sales. In 2023, the Minnesota legislature passed progressive revenue raisers that allowed our state to invest billions of dollars into education, but we are still lagging behind what our state spent on education when I started teaching 20 years ago in real dollars. Voters in many communities have passed levies to help our students with this shortfall, and many of these are for basic needs, like keeping buildings open, installing air conditioning and heating systems, and having safe staff ratios. Without these local property taxes, we would have even larger class sizes, less time for educators to prepare for the classroom, and fewer interventions available to our students. The Bloomington community voted yes to a tax increase of 4.4% in 2025. Despite that increase, our district is cutting $5 million for the 26-27 school year, which includes increasing student walk distances, reducing staff, and altering middle school schedules, which will eliminate many of the supports that adolescents need, like advisory classes and academic teams, while also increasing the job demands on teachers. Our students deserve fully funded mental health and physical teams, including school counselors, school nurses, school psychologists, and school social workers in every building. Our special education teachers deserve time in their duty day to meet with families and complete federally required paperwork. Our EAs and TAs should be able to work one job and earn a living wage. And our students deserve small class sizes so that they can get the time and attention they need to thrive. But under our state's current funding formula, we cannot meet these needs. Minnesota's economy is different than it was just a few decades ago. People purchase fewer things and more services. It's time that our sales tax reflects that reality and is broadened to include ad sales, both ads in traditional media and digital ads from the world's largest companies like Meta. Social media is contributing to a skyrocketing number of ads people are exposed to each day. Estimates are from 4,000 to 10,000 ads per day, with digital ads making up a large portion of those. Taxing these ads will help raise the funding that will keep Minnesota the best state in the country to raise a family. I urge the committee to support Senate File 4787.
Thank you so much. And up next, we have Mr. John Beshy. If you could go ahead with your testimony.
Thank you. Good morning, members of the committee. My name is John Beshy. I'm the State Director for the National Federation of Independent Business in Minnesota. Thank you for the opportunity to provide comments today. NFIB represents about 10,000 small and independently owned businesses across Minnesota, and our members span every industry and serve local communities throughout the state. We appreciate the opportunity to testify in opposition to Senate File 4787, which imposes a sales tax on advertising services, both digital and non-digital. Small businesses in Minnesota are already struggling with rising operating costs and a tax climate that is not conducive to economic growth. They've also recently been hit with a new PFML payroll tax, as well as an increased unemployment insurance assessment. A new tax on advertising services will add additional cost pressures and will disproportionately impact small businesses who use these services as part of an affordable marketing strategy. Small businesses often do not have in-house marketing teams, and competitively priced advertising is one of the primary tools that they have at their disposal to compete for and retain business. By subjecting a broad array of advertising services to the sales tax, the legislature will be negatively impacting the ability of small businesses to compete and grow. This will ultimately result in an invisible tax on consumers, as small businesses that operate on already thin margins will have no choice but to pass the cost through onto the prices of goods and services that they offer. Additionally, there is risk that this tax will incentivize the use of out-of-state marketing firms, which will further erode the competitiveness of Minnesota-based businesses. Instead of entertaining new ways to increase taxes on small businesses and Minnesotans, we believe that the legislature should be exploring policies that improve our state's competitiveness and bolster economic growth. Thank you again for the opportunity to provide comments, and we respectfully ask that the committee oppose Senate File 4787.
Thank you, Mr. Beshy. And lastly, we have Mr. Timothy Oat. I'm not sure if I'm saying that right, but I believe you're online. So if you could go ahead and introduce yourself for the record and go ahead with your testimony.
Hello, good morning, Mr. Chair and committee members. My name is Timothy Oddie. I'm one of the co-owners of Wild Rumpus Books in Minneapolis. I'm here to voice my support for Senate File 4787. As a co-owner of a small business with a community-facing mission, I believe that taxes are how we provide for our community's needs. It's important to me that big businesses pay comparable overall tax rates to the people of Minnesota. This bill is a step in that direction. I don't see this as an anti-business bill. I believe that any impacts to small businesses like mine are negligible and even offset by decreases to the state sales tax that will relieve the burden on my customers, while additional revenue raised by this bill will help Minnesotans thrive. Wild Rumpus Books is a specialty store dedicated to children and young adults and their families. The people that we're most beholden to are people who can't yet vote, so they don't have much say regarding legislative issues that impact them deeply, such as education budgets. As a small business owner who serves this population, I'm here to advocate on their behalf. They deserve, and we can provide, robust, flexible, holistic education that meets their needs, whatever those needs may be, and we can do it using revenue raised by this bill to increase money for schools. Wild Rumpus works with educators in a variety of ways, from helping to stock classrooms and school libraries to bringing authors to speak with students. All of our programming aims to support curriculums that are already in place, and author visits especially can offer kids an opportunity to see people who look like them telling stories about kids who look like them. A lot of work and a lot of resources go into these programs, all of which cost money, both to Wild Rumpus and to the schools. The revenue raised by this proposal can be used to make this work both easier and more impactful. I ask you to support this bill and make corporations pay into our community rather than simply siphoning resources away from us. I urge you to use the revenue raised to support the education of our young friends and neighbors. Please vote for Senate File 4787. Thank you very much for your time. Have a nice day.
Thank you, Mr. Odie. And with that, that is all of our testifiers. Madam Chair, did you have anything you'd like to say before we move to discussion?
Thank you, members, very much for listening to a discussion of what it will actually mean if we broaden the base of the sales tax and lower the rate. This bill, and I believe the governor's proposal as well, is not simply more revenue for the state. It's not revenue neutral, but it is a reduction in the overall sales tax rate. And I think in the future, you're going to see more attempts to do this, to broaden the base and reduce the rate. There have been many attempts in the last 75 years to bring Minnesota's sales tax system into the 20th century, for that matter, and now into the 21st century. We can continue to give tax breaks and tax increases through the income tax system, but we do have this so-called three-legged stool, which is getting very short-legged on the sales tax and consumer taxes, but it's going to continue to be a challenge in our tax system. And I recommend, once again, looking at, and we'll maybe come back to it because I have a whole lot of questions about the tax incidence study, about how this would fit in our overall either proportional or regressive or progressive tax system. I do want to point out as well, by the way, in the A2 amendment to which the revenue estimate is drawn, that what advertising services do not include, and that's in paragraph B, lines 122 to 126, and then generally the no impact on the sales tax for tobacco products, which is in section 3. We have tried base broadening since I've been in the legislature, since 1987, when we proposed expanding the base to, we had two choices: expanding the base to clothing and with no revenue neutrality, we needed the money, or raising the sales tax rate. And the 1987 legislature decided foolishly, by the way, in my opinion, to not look at base broadening, but instead raising the rates. And I don't know that we will have what kinds of opportunities in the future we will have to do that, but I think it's important for this committee to have heard both pro and con from various interests in the state, business interests, education interests, labor interests, about whether this is a valuable way to proceed. So with that, Mr. Chairman, and I'm going to go into that other bill momentarily, but I would ask you to lay over Senate File 4787 as amended, please. Okay. Or unless there's somebody that needs to comment.
Madam Chair, we did have Senator Miller, if that's okay. He did
Sure.
ask a
It's okay
little while
with me.
back to speak, so.
Thank you, Mr. Chair. Senator Rest, I'm wondering if, I'm looking at the revenue estimate, and I'm wondering if you can just let us know, or maybe fiscal staff, how much revenue Senate File 4787 brings into the state. So in other words, what is the amount of the tax increase? And then also, how much does the sales tax rate decrease, and what is the cost of that sales tax decrease to the state?
Mr. Chairman and Senator Miller, if you look at line 1, the rate reduction in FY 2027, starting in September, is $104,400,000. And then the base broadening has the impact in FY 27 of $183 million. And then moving forward with full years in 28 and 29, the base broadening, the rate reduction is $159 million and $162 million, which is essentially $300 million. And then the base broadening is in 28, 29 is almost $600 million. So that's the way I read the revenue estimate as prepared by the department.
Senator Miller.
Thank you, Mr. Chair, and Senator Rest. So the net effect of each of these would be the broadening of the sales tax would result in a net tax increase to the state of roughly $600 million over fiscal year 28 and 29. And then the sales tax decrease would have a cost to the state of roughly $300 million. So it would be a tax increase of $600 million and a sales tax decrease resulting in about $300 million.
Mr. Chairman, Senator Miller, that's the way I look at it too, because, and as I mentioned, this is not a revenue neutral proposal. If it were, the rate reduction and the base broadening would be similar. So this is not intended to raise the dollars without giving some relief in the rate reduction. However, and as one of the testifiers pointed out, it's still applying sales tax to an industry as defined by advertising services that does not pay it now. So on that segment of our economy, it is indeed a tax increase as opposed to, but at a lower rate than if we had just imposed it without any kind of rate reduction. So it becomes a policy choice, and it's one that this committee, and we seldom bring up bills like this that deal with sales tax, but it seems to me it is going to be an important discussion, certainly in the House, and the members of the Senate should be aware of it.
Senator Miller?
Thank you, Mr. Chair, and Senator Rest, thank you. And I do not support the proposal that's in front of us, but I would encourage those who do support it to consider lowering the sales tax rate even more, because there's an additional $300 million there that could be offset. And if you lower the sales tax even more, it'll provide more relief to Minnesotans across the state.
Indeed.
We're going to move to Senator Weber and then Senator Nelson. Sorry, yeah, want to go to Weber first.
Thank you, Mr. Chairman. And Senator Rest, I know it's going to come as a surprise to you, but I do not support the bill.
Yes. It's probably 8-1 in here, right? I mean, the other way, 1-8.
But
go ahead.
Anyway, I just want to comment. The reference was made that tax is going to be on the digital advertising going to be borne by large companies. There's no large company that has ever borne any tax. We are the ones that pay it because it gets reflected in the cost of their product to us. And in this particular case as well, I think about advertising. I go back to my district. In the 14 years that I've been here, the only daily newspaper in my district has went down to a weekly. And there have been a couple of weeklies that have went out of business. And every newspaper that remains has a digital advertising page that they utilize. Now, part of the problem why these papers have had to downsize or go out of business is the fact is they've lost advertising customers. We've seen businesses leave our communities with the shutdown of Main Street by Governor Walz in 2020. We saw many businesses not reopen, so they've lost their customer base. And the only reason that some of these newspapers even can exist is because they have a digital advertising page that they utilize. And quite frankly, their customer base has such thin margins that adding additional cost to them will probably cause them to lose some of those customers as well. And what happens when a local newspaper closes? The history maintainer and writer of that community is gone, because it's through the newspapers, the reporting of events, that the history of a community is quite frankly preserved. And so at the end of the day, I see this not as a revenue enhancer. If we want to help our schools, which we should do, we should rescind the 80-some mandates we placed on them the last 3 years, because that is causing their income and problems and expense problems. And so with that, Madam Chair and Mr. Chair, I have people waiting for me, and I thank you for letting me speak.
But
Yes,
Senator
Madam
Weber, Mr. Chairman, Senator Weber, just one brief thing. If you look at lines 122 through 126, what is not being taxed in this bill is advertising for printing newspapers, periodicals, magazines, publishing, radio broadcasting, television broadcasting, web hosting services, and domain name registration and services rendered in respect to advertisements produced for for direct mail. So some of the services that you mentioned will not be taxed under the bill as amended by the A2.
Senator Weber.
Thank you, Mr. Chair. But their digital advertising pages will still have to pay that tax. Because it's not print, it's digital.
Yes, I think that's correct as I read the amendment as well.
Thank you.
Okay, thank you. We'll move to Senator Nelson, and I do think we want to get to another bill, so I'll pass it
Thank
to
you.
But
Thank you,
only
Mr. Chair.
briefly.
I'll be brief.
No, I meant the other bill.
Okay. I'll still be brief. I know time's always at a premium. In addition to the fact that, I mean, we've already talked about that we're one of the more highly taxed states in general. But specifically to this, and to Senator Miller's point, this is a tax increase of $300 million. And so, but my questions are more detailed right to this bill. And I think I might have mentioned these last year. The concern is the Internet Tax Freedom Act that, prohibits states from imposing discriminatory taxes on electronic commerce. And that seems to be what this bill would do. And if we look at other states that have tried something similar, like Maryland and Washington, they're mired in lawsuits about that. So how would you think that your bill would avoid, or how would it, I'm just kind of concerned about, if this is just a thought, that's one thing to think about. But if it's something that you're actually looking to get enacted, that's a very concerning thing regarding the Internet Tax Freedom Act and how it's already been other states that have tried this are being affected.
Mr. Chairman, Senator Nelson, Maryland's tax is vastly different, as I understand it, from what Washington does. And Washington pretends to be a non-income tax state, although they try and get around that all the time, and that they base their taxes on solely on sales tax. So when we look at them, it's kind of like, well, that's interesting, but it's very seldom that we follow what the state of Washington does. And similarly, we look at Oregon, which doesn't have a sales tax and only has income taxes, and the way in which they try to impose a sales tax without calling it that. So we have to be very cautious about looking at certainly at the state of Washington for leadership in how we deal with sales taxes, because it's in many instances, it's very dissimilar.
Senator Nelson.
Just a comment. I don't know how the difference in those states and how they look at sales tax would affect the Internet Tax Freedom Act. So, and I'm not an attorney, but I'm just throwing that out there that it's somewhat concerning and something we should be concerned about. The second thing I wanted to mention that was concerning had to do with that it appears that this bill is actually taxing the business inputs, so it leads to kind of that pyramiding. Usually sales taxes are on the final product. And so this is like, well, this isn't exactly the final product. So the question then is, it doesn't seem like very good tax policy, but it seems like it could also cause some challenges.
Mr. Chairman, Senator Nelson, that is quite correct. This is a business-to-business tax, not the tax that would be imposed on the final consumer. So that is a change from how we have dealt with sales taxes in the past, and certainly my belief that the sales tax should be imposed on the final price to the consumer. This is nevertheless, you'll see it again in the governor's bill on a tax on services not just advertising services, but others as well. And if Minnesota is ready to go to a tax, the sales tax being applied on businesses to businesses. Maybe we're ready for that, maybe we're not. Mr. Chairman, again, I would request that you lay over Senate File 4787 as amended.
Thank you, Madam Chair. We will lay over Senate File 4787 as amended.
Mr. Chairman, we're not going to be able to take up the technical and policy bill, but I do, in terms of going through it, but when we return to it, I would like the amendment that is in the packets to already be on it. So, Mr. Chairman, if you would bring up Senate File 4690.
Okay, we'll now move to Senate File 4690. Madam Chair.
Mr. Chairman, I have the A26-0143 amendment. It is an author's amendment.
Okay, Chair Rest introduces the A26-0143 author's amendment. Those in favor say aye. Aye. Opposed, nay. The author's amendment is adopted. Madam Chair, to your bill as
Thank you
amended.
very much. Then, Mr. Chairman, I would request that Senate File 4690 as amended be laid over.
With that, we will lay over Senate File 4690 as amended. Madam Chair, any other remarks before we adjourn?
Mr. Chairman, we will return to Senate File 4690 as amended, and we will move to take it off the table at that time.
Thank you. And with that, we are adjourned.